Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat.
Paris milling wheat. The market here in August, as elsewhere, constructed a new pattern. It built a mid-August to mid-October ascending wedge pattern that is highlighted in dark blue on my daily chart. In mid-October, prices dropped out of this ascending wedge pattern, and after a reactionary move back up, that failed. The market pushed down properly through all the moving averages, halting briefly at the 50% Fibonacci line of the March 2021 to May 22 move at 315. In this move lower, this market showed an earlier bearish incentive compared to the other grain markets. So there were here, as elsewhere, avenues for prices to travel. And it chose a straightforward move down with appropriate potential targets for the ascending wedge pattern. Thus, the primary target on the downside was in the 331 zone, whilst the secondary harder to reach target was way down in the 296 zone. The primary target was easily achieved, but it took until mid-December to reach the secondary target, which in its way is an achievement, as none of the other grain markets have managed yet to reach a secondary target, realistically. I also posed a second question 5 weeks ago as to whether some of the supports would be enough to turn prices higher, and maybe, just maybe make a possible double bottom. Personally, I was at the time originally not so sure, as we have so much ammunition above the market which suggested the bearish incentive would be still here. My sentiment of not being so sure of a double bottom type action was clarified 5 weeks ago when I retired the concept. So where does that leave us now? Well, I pondered on this aloud at the same time thus, and I quote, "Take a look at the whole big action since the peak in May today as a possibly, just possibly, a very, very large bearish halfway hesitation in the making. To clarify, it is possibly in the making and is not made, not yet. This is a ginormous pattern, and one which eventually leads down to something like the 225 area. I am not prepared to call it that, not yet. However, we may have another bearish but less aggressively bearish pattern, though not necessarily by much. It is the mid-June to date bear channel, currently 259 to 235, which is highlighted in bright green on my daily chart. I'm not saying either of these two will be the way forward, but if you favor the bearish side, then these are worth considering." End of quote. These still stand as ideas. Both have merit. To these two, I'd add a further short-term pattern, and one that has worked pretty well even this week. It is a mid-November to late December last year bearish Andrews pitchfork, which has been excellent so far in indicating the bearish angle of attack, the short-term bearish angle of attack. The market is at this time in between the middle time below, currently 277, and the upper time above, currently 289. Now, so far, unlike some of the other grain markets, this one is not, repeat, not showing a weekly key reversal this week. So it'll be interesting to see how this market reacts to all the other actions we've seen in the other grains markets. London, UK feed wheat. In mid-October last year, the market made a weekly key reversal down that broke down through the lower bull channel line of the August to October 2022 move and started the next major piece of action, a move lower. Prices additionally broke down through all the moving averages. This left us here, as elsewhere in the other grain markets, with a choice of avenues going forward. Eventually, the market chose, as I described it 8 weeks ago, and I quote, "a straightforward move down with potential targets for the break below the bull channel." In this case, a primary target on a downside was already achieved in the 269 zone, whilst the secondary harder to reach target X1 is almost achieved in the 239 zone. End of quote. Prices finally dropped down in early December to reach the secondary target in the 239 zone. I also laid out 8 weeks ago the next possible scenario, and I quote, "We now have to see if the 239 zone will hold this decline, which includes a previous all-time high at 238.70. If it doesn't, then there is a series of old congestions, some dating from 2012, between 230.10 to 223.10, and another dating from 2013 between 215 to 217.80. These may in turn be in the frame, but first let's see what the 239 zone holds in store. End of quote. Well, once reaching 239, prices hesitated as I thought they might, but in early January this year they resumed their journey lower. It is at this point that I will bring in my last words from 7 weeks ago of a new pattern, and I quote, "There is one potentially new factor to add into the mix. I am even not sure if it is genuine or not as yet, but we may have an October to date small bear channel. Currently 197.10 to 214.90. That's what it is at the moment. I've added it onto my daily chart, but for the moment I've chosen not to highlight it, at least until I can see it perform. The one thing it has in its favor is that the short medium moving average, that's currently at 224 even, seems to be paralleling it." End of quote. 5 weeks ago I decided to highlight the bear channel, this bear channel, and that's in purple, as it was showing an excellent idea of the bearish angle of attack of the market. Now the only amendment I have added since then is a bright green, shallower amended bear channel, currently 209.60 to 227.90, as it seems a better fit if you take the breach above the upper bear channel line of the original bear channel into account. This past week has shown the value of this shallower bear channel, as it has better shown the bearish angle of attack since late November. I originally thought that this choosing time, if you like, would be towards the middle to end of February, when the two bear channels, well, they part ways. But it seems that events have overtaken this timetable, and this week could be a seminal moment here. You see, we have a possible weekly key reversal up-in process here, if only just. Thus, if tonight prices close over 223.20 or under 217.20, then we'd be on. Right now, we are ever so much looking at a weekly key reversal up here, but again, it's if only just. Thus, the opportunity to reach target X in the 180 area is under severe threat. 180? 180? What is that about? Let me explain. As I asked the following question back late last year, and I quote, "What's next?" Well, prices are now running into a congestion band below between 223 to 230, which has the 2012 high within it. It is a reasonable piece of congestion, but it may be no match for all the ammunition stored overhead between July and October. Thus, we need to look a little further, and this is where the way out ideas come to light. What if the action since mid-May to date is a huge bearish halfway hesitation, a really, really big one? In that case, we would be looking at potential down in the 180 area. I'm not as yet advocating this as a pattern, but it might turn out to be so. It will depend on how the market treats the congestion below between 230 and 223, and the smaller ones between 215 to 217.80, and also between 205 even to 206.40. Watch carefully, especially the integrity of the bear channel in purple. End of quote. Last week I decided to place a potential target X in the 180 area. I am now wondering if I will be regretting that decision soon. And I will finish with a great big question mark over all of that.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.